Hi everybody, Harvey here, the remote property investor, and I'm here to bring you another property market update. In these updates, this is the time of the month when I accumulate all the information from all the other major influencers in the property space, and I bring it to you here in one place, and I have my own little twist to this. And a good mistake happened this month, which has helped me out. I've made the first video on this and the quality come out poorly, so I'm re-recording this, but it's great because there's been some major changes, so stay with us to find out what the major changes have just occurred in the property space. But in the meantime, if you're new to this channel, or if you're coming back for another time and you're not already subscribed to the channel, hit that subscribe button, hit the bell icon so you get notified every time we do content like this. We're constantly pushing that. We're pushing that, this sort of content once a month, but we push out content all the time. Also, please hit the thumbs up. It really, just stroke it. You don't have to smash that screen or anything. You can just give it a light stroke. It really helps the algorithms push that out. My why is to live on my own terms. My mission is to help as many people live on their terms, using property as a vehicle to do that. So if you can help me out and get this message spread, that will be absolutely amazing. So what are we going to cover in this property market update? So we're going to cover house prices. We're going to cover sales. We're going to be covering rent and rent prices, what's going on in the rent prices. We're going to be covering mortgages, what's going on in the mortgage market. We're going to cover, here we say it, inflation, and dare I say it, interest rates. So really jam-packed little session this week. And also what I'm going to cover as well is a little bit of predictions going into next year. It's not going to be my full prediction. Watch out, definitely subscribe, watch out in the future for a video to come when I'm going to give you my full predictions for 2022, but we'll touch on that lightly at this stage here. So let's start on the part of the market that's really interest for all of us all the time, and that is house prices. So house prices are starting to cool a little bit, but the market is still remaining strong, but things are starting to ease off. So what I'm doing here is I'm going to bring you some data. That's why I've got my laptop with me today. I'm going to bring you some data from some of the leading places to collect this information. So your Halifaxes, your Nationwides, your Rightmoves, your Zooplas. These are places to collect this data. Bit of difference between Halifax and Nationwide. The difference between Halifax and Nationwide, Zoopla and Rightmove is Halifax, Nationwide collect sold data. Zoopla and Rightmove collect marketed data, so they all collect the data from stuff that's being like asking price, not necessarily the end sale price, but they still give you an indication of where the market's going. So let's have a head over and have a look first of all at our good old friend Rightmove. So Rightmove, let's look at the average sold prices. So the average sold prices will give you an indication on where the market's at. And as you can see from this chart, this is from November 20, and it comes through up until November this year, and we can just see that dipping off on the asking price trend. We've been up and up and up. It's going up. It cooled here around the summer holiday times, and we're just dipping back. And then when you look, this is a big indicator on the market. If you look at the average time it takes to sell a property, this will give you a real snapshot of how warm the property market is. Obviously, the shorter amount of time it takes to sell a property, the hotter the market is for like demand, so a lot higher demand. And as you can see here, you can see this dip down in the time it's taken, but we're flattening off, which shows you signs. As a property investor, you don't want it to be a hot sales market. You want it to be a buyer's market. When it's a buyer's market, what I mean by buyers and sellers market, at the moment, it's been, over the last 18 months, a good seller's market. So it's more favourable towards the person trying to sell the property, because the time to sell the property is shortened, meaning that they're not as motivated to sell. As property investors, we need motivated sellers. And the longer it takes a person to sell the property, the more motivated they'll become, and the more they can reflect that in their price. And again, when you look at this is just stock levels as well. Stock for me has been one of the main indicators. There's loads of, like, imagine we've got a big cauldron pot here and we've chucked in loads of ingredients into the cauldron pot and we'll give it a big stir. There's loads of things contributing towards these high prices at the moment and the hot market we're being in. But definitely one of the big playing factors for me is the amount of stock levels. You can see this just dropping down here on this chart, how much stock is available. So let's head over to Zoopla's, Rightmove's good old friend Zoopla, and see some of the information they've got on their chart, on their like statistics as well, because they all differ slightly. They all collect it from different ways and different forms. So if you get all this together, you can get a really good reading. This is why I brought in a few major sold prices, predictions, indexes, and market prices indexes as well. So here you see their annual quarterly house rate growth. And they're saying that it's easing without a shadow of doubt. You can see this dip off here. It has been shooting up and we've had a major dip off. But this chart's interesting. Here's how prices have grown in cities over the last quarter. So you could look, and this is what interests me. London's always been the leader, but it's down here. This is their growth percentages. And you can see, wow, is a surprise one for me, but it's out there in front. But you can see these two different, the purple to the dark, like is it black or dark purple? But these are the two different lines. So this one is in October, the darker one, the lighter one is in June 2021. And you can see this really like cooling off across here, the difference between June and October. Again, like on Rightmove, it's showing you the stock levels. So your stock levels here, you can see the difference between the stock levels here, and this shows you running at a half year, at half the 5-year average. At the moment, look, we are way down here. The purple one's houses, and the lighter pink one is flats. Let's jump over to Halifax and see some of the data they've been sharing at the moment. So their headline on their index is house prices rise for the 5th straight month, with the growth now at a 15-year high. But you can see on these indicators here that this blue one at the top is your annual changes. This sort of greeny colour one here is your monthly change, is your quarterly changes, and this pinky sort of colour one at the bottom is your monthly changes. So you can see the difference in these house price changes, and this is based off of like actual more factual stuff. Look, the average UK property price is now at a record high at £272,992. Quarterly house price inflation now at the strongest level since 2006. 2006, don't forget, it's when just before we hit that crash. Are we showing similar signs of heading towards this? Who knows? Welsh average property prices break past 200k for the first time ever. So Wales has really surprised me. And if we jump over to Nationwide, the other major player in the indexes, let's have a look at their annual percentage changes in UK house prices. So we can just see this change softening. As I said, we can see this growth up here and then a major soften as we're coming in to the later part of the year. So there's a number of things that could be influencing this cooling off. It's not cooled down by no means. We're still in a really strong market, but it's cooling off at the pace of growth it was. And a couple of things could be happening. Is this a signs of getting to the end of the stamp duty holiday, the furlough scheme? Is this the consequences of coming out of those schemes? Or is this just a case of every Christmas we get a lull around Christmas anyway? So there is a mid-cycle, like there's a mid-year, not mid-year, end-year dip. You always get a mid-year dip as well, which we had this year, which bounced back out of that as well. So this could indicate towards this is just the time of the year, not the other factors in the market, like the stamp duty and the furlough scheme and these other schemes ending. But let's talk about sales. As I said, you can see the stocks, you can see all these different charts giving you different indications. But a big thing that's happened, sales have dropped 52%. That's correct, 52%. So as I said, this is all good news for property investors. Of course, if you've got an existing portfolio, the growth is fantastic for your existing portfolio, but for finding new deals, it's very much a seller's market, and you get deals from motivated sellers, as I've previously said. So this is good news, trying to level these things up. We want the stockpiles to come back up. We want people not to be such a seller's market, so it becomes much more of a buyer's market again. Now let's talk about rents. As investors, I'm more interested in my rental market and the strength of my rental market than I am the strength of the growth of the properties. Capital growth is great, but very much for me, it's about cash flow and monthly cash flow. And the rental market is really on fire at the moment. We have seen the fastest rise in rents in 13 years. Even London dipped behind, the major cities did, but they're all recovering as well of their rents as more people are getting back to work, as more people are getting back in the offices, although who knows with this Omicron new variant how that's going to play out. But rents in most other parts, especially in my city, my remote location, Stockton-on-Tees, they are absolutely on fire, and the stock levels, very much similar to the stock levels to purchase, are really down. There's not enough availability for rentals on the market, which it don't take an economic whiz kid to figure this out. If you've got low supply and high demand, it pushes prices up. Mortgages, let's talk about mortgages. And I'm not sure if this is going to, Bank of England are talking about relaxing the rules around the 5 times multiplier. So one of the biggest reasons, we see London, how that's been performing in comparison to a lot of other places. And one of the big reasons behind London is the price per earnings ratio of affordability for people. So the price they earn in wages in comparison to the ratio of percentage of what it is to buy the property. In London, it's around 18 times the average wage, you know, and if you can only lend 5 times the multiplier of your income, this really stumps a lot of people. So they're talking about increasing this. I don't know if this talk will get any more momentum with what's going on with inflation. We'll talk about that in a minute. And with the interest rates, we'll talk about that again in a minute. And we'll come back to that. But there is talks about raising that above 5 times. Only way I can see these cities that got a really wide price per earnings ratio percentage doing well going forward is if the wages dramatically jump up, so that shrinks that gap, or they lend more of a multiplier. Will the policy makers allow that multiplier to go too wide? I can't see it going too wide, but I can see it probably raising from 5 times multiplier. There's lots of talks about long-term mortgages for first-time buyers, 40-year fixes, which if they did raise it above a 5 times multiplier, I believe that would be the right way to introduce this and could be favourable, done responsibly. Inflation, we're now going to talk about inflation. Inflation hits a 10-year high as energy, fuel and clothing costs just jump. So I'll quickly read this from the BBC article. So the cost of living surges by 5.1% in the 12 months to November, up from 4.2% the month before, and the highest levels since September 2011. So what does this spell for property investors? High inflation. So high inflation is a kind of double-edged sword, because ultimately on one side inflation shrinks debt. So if you've got a leveraged portfolio with debt, it's going to shrink your debt. But on the other side, it pushes debt up as well. So interest rates on your mortgages, like usually the lever that you use to reduce high inflation is by actually higher interest rates, which we'll come back to in a minute about interest rates. But yeah, it's a double-edged sword, inflation, for property investors. So let's take a look at this little chart from the BBC. As you can see, this is what inflation has looked like before. The long-term target for inflation was 5%, and we've not been there for a while. We've massively dipped out. So if you look over the years here, so in 2011, the long-term target for inflation, is 2%. You can see by the dotted line across the middle. So around 2011, we peaked above that, and that's just as we was coming out of the last recession, coincidingly alongside when they print a lot of money. So when you put a lot of money supply into the economy, it really can have an effect on spiking inflations. We've had a few other pressures, like a backup, like on this inflationary run we're going on at the moment. You've got to think about a lot of suppliers shut down in that first lockdown, and then when we open back up, especially in the property market, materials, shortage of chips, like computers and cars, have really led to a backlog, and they're all struggling. They've all been struggling over this last 18 months to get back up to supply, because we've opened the doors back up from that first initial really severe lockdown, and they couldn't keep up with the demand. And with the fact that there's loads of liquidity pumped into the market, and especially at a more grand level, so people got bounce back loans, they got C-bills, they got mortgage holidays, they got credit card and loan holidays, loads of money come into a lower level. So more liquidity into the market means people spend. So when more they're spending, if the demand can't keep up with it, which it was struggling to keep up with because of the lockdowns, and a lot of production went on pause, it's really pushed into the factors that go towards we're getting into this inflationary state. So if you look at this chart, look, around 2011 we hit a peak, last time we printed a lot of money, but at the moment now, their prediction for inflation was it was still going to be under 5% this month, and that's why they're super worried at the moment. That's what come back to interest rates, but that their prediction was going to hit around 5% in April, and it's now hit that in December, way above before where they thought it was going to hit that. And if you look at this here, look, you can just see it spiking. You can see it dip down here. In 2019, it's dipping down. It was below where they wanted it, their target. That 2% is their target, and now we're at 5.1%. So that brings us nicely into interest rates. So one of the levers, as I said, to try and slow down hyperinflation is raising interest rates. Because the more liquidity, the more people spend. The lower the interest rates, the more people spend. This is the theory behind it. The higher the interest rates, the less people spend. So one of the impacts it could have on the property market is it definitely could slow up the growth of the property market. So I don't think the government feel that's a bad thing at the moment, because they've took a snap decision on raising interest quicker than anybody expected, especially with this Omicron variant coming in, and a lot of sectors over Christmas and hospitality are already starting to get hit with the uncertainty of this new strain coming in. So interest rates, this is another article from the BBC, interest rates rise for the first time in 3 years, so before the pandemic. So I'm going to read this from the BBC. So the Bank of England has raised interest rates for the first time in more than 3 years in response to calls to tackle surging price rises. The increase to 0.25% from 0.1% followed data this week that shows prices climbing at faster pace for 10 years. It came despite fears that the Omicron variant could slow down economy by causing people to spend less. The bank's action is set to increase the mortgage cost of some home owners. So if you're a homeowner, the impact for you is going to increase. It's going to hit the mortgage cost of that when you come to renew your fixed term. If you're in a fixed term, there's nothing to worry about until you get to the end of your fixed term. But if you're in a variable rate, it's going to go straight up straight away. If you're in a tracker mortgage or you're stuck on a variable rate, it's going to go up straight away. And we'll talk a little bit more around variable rates and protection of what you can do as property investors. This can definitely have an impact on property prices. Property lending, like another reason the property market has been moving on is the supply and demand issue, or liquidity of the supply and demand of availability of lending. So lending's so cheap, but people are taking that at the moment, which pushes the prices up. But if lending gets less cheaper, it gets harder, affordability gets harder, and affordability price per earnings ratio is already wide. So if you notch that interest rate up, it's going to slow the housing market down in growth. I believe the government and the Bank of England policymakers have took this decision consciously. So the Money Policy Committee, the MPC, have voted 8-1 to rise this, even with the uncertainty with this new COVID variant spreading around. It surprised me slightly. I didn't think they would take that stance, but the thing it probably will affect the most will be the mortgage market. And the reason I think they might have taken this stance is, this is my view and opinion on this, by the way, but the reason I feel they could have taken this is because I don't think the property market's been their thing that's been boosting along, giving everybody a good morale, and the government have really helped that along. Now it's hit a point where the price per earnings ratio is wider in the average home, like the average first time price is like average national prices going up. So I believe they don't mind slowing this a little bit. So that's probably one of the impactful things it might have, and don't mind slowing that down just a tad. But it's only gone up from 0.1 up into 0.25. But again, if you look at this interest rate chart here, so this takes you back from 2005 and where it was up around 6%, and you can see this here drop down, dip up again, and then come back down since COVID, and it's been down in a slight raise. So the Bank of England's long-term target for interest is at 5%. But as you can see, we've not gone above 5% since the last crash. So before the last crash, we was around where they wanted it to be, but then we're bottomed out. And we so-called recovered around 2011, 13, 14. The economy had meant that we recovered. So I'm not too worried about this spiking out of control and going up to 5%, or even what we had in the past. So a lot of people talk about the past. When Margaret Thatcher in the 1980s, interest rate hit around 18%. So look, 17% at its peak in 1979. But you've got to look at the household debt ratios in comparison to their earnings. So back then, the average property in London was around 16k, and the average earnings were around 6k. So this is why it could absorb this higher rate. So back to these current times, in my opinion, the reason this didn't lift up after the last recession come out is because of the debt ratio into the houses, and that's just getting increased and increased. So the interest rates come down. The way they kept on moving forward with the housing market and borrowing is by bringing the interest rate down, which is expanding that debt bubble even wider. So the debt expansion has been ginormous, bigger than it's ever been in history. We've never been in a period where we've pushed so much debt into the economy. You've got to think, even when I was a kid, consumerism wasn't at the level it is today. Not everybody thought about having these holidays, and not two parents had to work. It's really, really driven on. So for me, interest rates are not worrying me too much, but for two reasons. Number one, I'm in an area that can suffer an interest rate rise. But number two, I believe if they could have dragged this off, and this is just my thoughts, by the way, I'm not a financial advisor. This is just a very basistic observation of mine. But I believe if they could have risen it dramatically, they would have done when we was in recovery times. So I believe they want to raise it. The Bank of England announced a little while ago their long-term target's no longer 5, it's more like 2.5 to 3%. I believe they do want to get it up. They're in the business banks of earning money from interest. So if they could get this up to 5% or even back up to 18%, when they're loaning money, they're going to earn more money. So if they could, for me, after the last recession in 07 and 09, after we collapsed in, I believe that it would have come up by now. And the fact that we've got such a big debt expansion, I believe it's going to go up, but I don't believe we're going to go out of control with this. But who knows? If we get into hyperinflation, then we don't know. But that said, there is arguments like if you come across a lady called Cathy Woods, check her out. She's saying everybody's got this wrong. There's not going to be massive inflation. This is just a small blip. She's saying loads of these back-end suppliers and these manufacturers are getting back up to speed with where they need to be and actually over because of the demand they've had. And she's saying with tech, artificial intelligence, we're going to actually get deflationary factors stepping in very soon. Love to hear in the comments what you think, whether we're going to keep on getting hyperinflation or deflation. She's definitely got her argument for that. It's beyond the level of this video, but check out some of her videos to see her point of view of that. But it's definitely interesting times we're in. But as I said, I'm not too worried because I've got assets. So the difference between a high yielding asset and a high cash flowing asset is exactly this. So for example, if you bought a property, let's say you bought a property in the south for around 300k and your mortgage was around 600k. These are not exact figures. This is just give you a hypothetical example, just the principle behind it. And you rented that for maybe £1,100 a month. After cost, you might cash flow £400 after running cost and things. And you take £400 a month. That's a decent cash flow, £400 a month, but it's not a decent yield. Because if the interest rates rise and they double from 3% where we're roughly at the moment in a limited company, and they rise to 6%, what happens is your £600 mortgage goes to £1,200. If you're only renting it for £1,100, you're going to get hit hard. So you take this into areas where you've got bigger yields. So for example, in the Northeast, in my remote location where I invest, you might buy property for around 60, 70k, and the mortgage might be around £100. These are just simplistic numbers just to make the example easy. Nobody beat me up. These are not exact figures, but my mortgages are all between £100 and £200 a month, and my rents are all between £500 to £650 a month. So you think about it, if I've got a £100 mortgage and it doubles at 3% and it doubles to 6%, it's at £200. I've got a lot of margin in there to absorb that. So high cash flowing assets are really, really important. Having strong residual assets like single let properties for me, really important. So I've got an SA, and this in November, before all this news come out, but obviously Omicron and variants probably had an impact on that. I mean, in a tourist area, which obviously it's winter anyway, which is going to be impacted, but it made a loss, actually made a loss. But I can absorb that because I've got a strong single let portfolio. When we went to that last pandemic, at the start of it, the properties that got affected the most was HMOs, service accommodation, people with big projects on. So I believe, I talk about this all the time, your pyramid and your foundation of single let properties at the bottom to support all these other strategies is really important. So if you've got some high cash flowing, low purchase price properties, like that's the reason I buy in the Northeast and not locally, single lets, this will ride you through all these different fluctuations. If the interest rate goes up too much, we might get a market crash in prices. If that crashes in prices, you want to know, if you come to the end of your fixed term, can it absorb being in a variable rate if you've got full leverage on it, 75% loan to value? You've got to think about, am I going to be able to get lending on this again? If I'm not, it's going to go into a variable rate. The variable rate might be based off the new base rate that might be 2%. I don't believe it's in the base rate, it's going to go to 2% anytime soon, but you just don't know where it's going to go. So you want this protection in there, wrapped into your portfolio, and the single let properties really are going to be strong for doing that, and with that residual income. Again, another thing that don't worry me, and one of the attractions of investing in the North for me is that between that 5 and 650 a month, I'm not far away from housing benefits rates. So if people lose their jobs, it's not a massive jump down. Where in a lot of areas where the rents is like 11, 12, 15, £1,800, it's a like £300, £400, £500, £600 shortfall from housing benefits. So if people in your tenants start losing their jobs, you've got a massive downfall. So these style properties that I invest in are really recession proof and strong properties to drive you forward. And you've got a foundation of them, and then you stack on top of them the stuff that's much more exciting, the much more higher cash flows, but a bit more riskier. That's what rides you through these ups and downs. So let's wrap this up with my little view. I'm going to go into this in more depth. Where do I see next year going? I see it going in any which direction you could imagine. We don't know what's going to happen with COVID, so none of us got a crystal ball, none of us can predict this. But that said, I believe as long as COVID don't run out of control, this new variant, and we stay at where we've been with things, with the pandemic and the virus, I believe we're going to continuously get this cooling. I think we're still going to have a strong market. I still feel it's going to play throughout the year, but I feel it's the growth will still be there, but it's going to continue to slow and dampen and dampen and dampen, and more opportunity to create off that. More properties are starting to come through from the repossessions. Stockpiles are starting to come back up again. I think it's probably a positive thing for property investors who invest in the right style property, as I said, that gives you protection against these markets. It's a positive thing because less people will be buying because interest rates will go up and people will be uncertain, so it become a massive opportunistic time. Any single cycles, there's always opportunities about digging them out. Wherever there's change, there's opportunity, but as long as you give yourself that protection for the ups and downs. Listen, my why is to live on my own terms. My mission is to help as many people live on their terms using property as a vehicle to do that. Please do me a massive favour, help spread this message out. If you've not done it already, hit that subscribe button, hit that bell icon so you're notified when we do videos like this. Also, thumbs up. You don't have to smash away at your screen. You can just caress that or stroke it lightly and just make sure you turn it blue, and that will help the algorithm get that out there and help my mission and my why to help as many people live on their terms. But remember, if you don't evolve your ideas, you're never going to live on your own terms. So evolve your ideas, live on your own terms. Have a fantastic Christmas, everybody. Have an amazing new year. Don't forget to get your goals set in for next year. Get going. There's loads of opportunity in every single market. And please DM me in the comments if you want a little bit of support or you want to jump on a discovery call where we can help you move your business forward. No sales or anything like that. It's just a straight call where we can help you decide where you are in your business and move your business forward. Have a fantastic day, everyone.